In 2021, global M&A deal value peaked at about $5.9 trillion. A couple of years later, it had dropped by about 40%. But then in 2024, an interesting thing happened, because while the number of deals still stayed below peak levels, valuations started to ramp up a little bit in the tech sector, but especially for those companies that were prepared for their sale. And I think the lesson there for founders of tech companies is that the difference between a good exit and a great exit often comes down to just one factor, which is readiness. So I want to welcome you all here. I'm Paul Ellis. We're really pleased to be sponsoring this Tech Week panel on the current M&A environment for technology companies. We're going to be focusing for founders who are preparing to get their companies ready for a sale. Now, that may be a couple of months out. That could be a couple of years out. Regardless, what are the things you need to be thinking about in advance to be ready when the time comes? We're going to be talking about what buyers are looking for, how to best position yourself to stand out in a competitive market, and what the factors are that drive the best deal pricing. I'm really pleased to have a great panel to discuss this topic today. We have two seasoned M&A experts who spend their days negotiating M&A deals. We have 𝗪𝗵𝘁𝗶𝗵𝗀, 𝗪𝗵𝗪𝗁, both of whom really specialize in working with tech companies that are in the process of a sale process. Ben is with 𝗪𝗪𝗀𝗀 Capital and Ali with 𝗪𝗵𝗂𝗃 Investment Bankers, right? So we are going to focus again really specifically what we can do to attract buyers and what you all as founders can focus on to have the best chance of getting a really successful high value exit. Before we jump into the substance, we're going to do quick introductions. Again, my name is Paul Ellis. I am founding partner of Ellis Law Group. We are a 12-person boutique firm located in Midtown. We do a lot of work with startup technology companies as well as venture capital funds. Our clients are looking for us to give them cost-effective solutions to their legal problems so they can focus on growing their companies. In addition to working in the M&A space, we work in venture capital and angel finance. We do IP protection, employment agreements, equity plans, general operations. Our lawyers all come out of top law firms and major top law schools. So we're able to get big firm expertise with the more reasonable cost structure of a boutique firm. In recent years, we've had a lot of clients that come to us out of major firms. They tell us that the costs are so high in the big firms. They find our combination of startup and VC expertise and our reasonable billing rates makes for a compelling value proposition. I always enjoy talking to founders who are doing cool stuff, so I hope to have a chance to speak to a bunch of you after the panel. With that, I will turn it over to Ali.
Thank you, Paul. Thanks everyone for coming today. Ali Masood. I'm a director at 𝗪𝗵𝗀𝗃 Investment Bankers. We are a boutique lower middle market investment bank. It's 40 of us in 5 offices in the US. Our headquarters is in Florida. We have an office in the New York area, one in Atlanta, one in Chicago, and one in Denver. We work with companies sort of in that $20 to $150 million enterprise value. So lower middle market. My background is in tech. I've been an investment banker for 8 years. Prior to joining PC, I was at 𝗪𝗲𝗄𝗃, and I was a tech and software banker. Ben.
Yeah, hi, 𝗪𝗵𝘁. I'm a founder of 𝗪𝗵𝘁 Capital. We're also a boutique investment bank headquartered in New York. We do a lot of mainly sell-side transactions, occasional buy-side as well, all in the tech sector space. And I'll hand it back to you.
Great. Thank you both, and really pleased to have you on the panel. So we're going to start out with a few general questions and talk about the market at a high level. And maybe we'll start with you, Ali, just to give us a sense from your perspective, what's happening in the M&A market right now in the tech sector, and how it's being impacted by current economic and geopolitical trends.
So, as you mentioned, 2021, 2020, obviously we had like the best years for M&A in general, the tech, software specifically, because of sort of lower cost of capital on the debt side. That was a major reason, and that resulted in very high valuations for software companies. And even, companies with lower, kind of not that favorable KPIs, maybe in a lot of, situations, but that has already, changed. And specifically in the last, couple of years with, cost of debt rising, and obviously now it has, stopped and gone down a little bit, but that trend reversed. But we have seen since last year specifically that, deals are coming back, activity is going up, but the investors are putting a lot of focus and attention on high quality companies, companies that are profitable, that have very good sort of revenue base, that have high retention, that is recurring, obviously, and they have good pipelines that can support a reasonable growth. So that has helped the sort of the tech sector and software sector to do a little bit of a comeback. AI has been very important in terms of helping companies with new products, helping their operations, saving on OpEx. Talking to Ben before the panel, that has been a major factor. We've seen a lot of companies that have been very positively affected by that, and hopefully that will continue, because we see a lot of companies that are just trying to figure out sort of how AI works and how they can sort of fold that into their operations. But as they get better at it, obviously that's going to be additive to the value and deal process.
Yeah, I think it's an interesting environment right now. We're doing a buy side for an Indian company. It's 1.2 billion market cap, and it's public in India. When India actually is kind of shielded from the whole tariff controversies because they have good relation to the U.S. As opposed to China. I hate to be in the buy side in China right now. That fell off a cliff. But there are certain pockets like India where they actually want to buy into the U.S. market, which is still a very attractive market. There's a lot of growth. It's a huge market. It's where innovation is. Like AI is a good example of that. Most of the AI is here. So if they want to buy in, they buy here. Another area is supply chain. Sage just bought a company, which is interesting. And then the third area is defense, right? Defense is, fortunately or unfortunately, a hot sector again. Because we've got a couple of wars and hopefully only 2. So,
Thanks for that, Ben. You mentioned the tariff situation. What do you guys see? What is the impact of that sort of uncertainty on the marketplace and on the exit market at this point?
yeah, it's definitely an impact. It's hard to plan. I think things are a little slower than usual. But, I think given another couple of months, it's like, I think Trump only has so many tariffs in so many countries. So eventually it's going to kind of wash through the system. And, there's still GDP growth on the horizon, so I think we're okay there as well.
One thing that I can mention here is in terms of costs of maybe offshoring, resources, that's going to be affected probably by tariffs. We're working with a client that's had an offshoring basically partner in India that used them for back office sort of software development. They're already saving 70% by using AI and a couple of onshore people and just slashing that cost. So definitely a positive effect.
Yeah, I would say also that we were seeing a lot of activity December, January, and then February, March, early April, everybody froze up. Everything stopped for a while, and now things begin to get started again. So I would agree. It seems like we're hopefully the market and the level of activity is on the upswing at this point. So in light of the where the market is now, how does that impact for the decision buyers are making, and are they evaluating companies differently in any way? Maybe your exposure to tariffs or
in the software world, investors, you look at different KPIs, but I would say the most important of those are, something called Rule of 40 and retention. So Rule of 40 is basically sum of the EBITDA margin and the revenue growth. In 2021, for example, as Paul was saying, the high kind of best times where, deal volume, everyone was just looking at growth, how the company's growing their revenue, and they didn't really care that much about profitability. Right now is the opposite. They look at how profitable companies are. They care that if they're growing, but they're not really sort of obsessed with growth as they were before. But they definitely want to see tight operational sort of aspects of the company.
Unless you're 50% growth and 10% negative margins, right? And then you're still in the Rule of 40, right? That's where exactly. It's interesting. I think they're looking at much more strategic fit. So it helps to be on the buy side because you see the process, and it's much more complex than you typically understand the sell side. You don't see all of it on the sell side either. So what they'll do is you'll approach the corp dev guy on the other side, right? I'll use the example of AI Ops. I sold a company to BMC, backed by KKR. So approached the company, knew the guy for years, sent out a teaser. He ignored me for 2 weeks. Sent it out again, ignored me. Third time, he goes, "Oh, this is kind of interesting." Oh, yeah, it's a freaking great bet strategically. So he goes, "Yeah, it is a good bet. So let me, So what he does, he's going to circulate it internally to his tech guys first. And they'll go, "Hey, this is something we don't have. It's a great bet. It fits right into our AI Ops strategy. We need this desperately." And then they'll go to their sales guys and they'll say, "Hey, can we sell this product?" Right? And they'll do a global sales analysis, come back with the number, cut that number in half for risk, and then give you half, broadly put, right, for the valuation. So it's really important on the sell side to understand, if you have, especially the few buyers at the table, what their motivations are and what the strategic fit is from their perspective, and also the process they go through.
So another topic I'd like to touch on, sort of relative to the current market. In our firm, we are seeing a decent amount of M&A activity lately, but a lot of it involves distressed companies. Though not the happiest topic, but it's sort of the reality of a lot of what we're seeing in the marketplace now. So we have clients that are making strategic acquisitions of other companies that are basically running out of cash. And we see situations where, a company spinning out assets 𝗪𝗵𝘁. What is you guys have thoughts on that about the types of deals you're seeing in that way? Are you seeing an uptick in these types of deals?
For sure. Yeah, I think it's good to note that kind of a good target market is not only the big strategics. Everybody wants to sell to Microsoft or OpenAI, which is great. You should approach them, but typically, it's going to be the mid-sized public companies or private equity portfolio companies, or another target market people neglect is well-funded startups. They're in the same sector but adjacent, right? So it's not directly competitive, but it's adjacent. And a lot of these distressed companies are a perfect fit for that because they want the tech. It's a high valuation because these startups that are well-funded all have high valuations. So you're trying to keep your high valuation, which is not a bad thing. So that's a good target market to have. But I think the other distressed aspect is venture capital-backed companies, believe it or not, because the VCs, the venture capital firms, are getting a lot of pressure to get some liquidity back to their LPs or limited partners. A lot of pressure. Same private equity. Same thing, private equity. They also have their own. People forget that your funder is funded, right, at the different level. And there's a lot of pressure to show liquidity. So they're being encouraged to sell for 100%, not a minority investment, and to get rid of some of their distressed assets as well.
One thing to add here is, for a strategic, in terms of they look at their product, their portfolio of products, and they look at, some of these companies that were going for, 20, 30 times ARR 4 years ago, but they couldn't figure out the, go to market, but they have a very good core team. They have a good product. So that product can just fit into like a larger strategic portfolio and be very involved in a few of those. So having a good product always, obviously is a very important factor that can save a company.
Yeah, I would agree. I've seen a few deals like that recently where a company that had an outstanding platform, great relationships, but just wasn't making enough money. And to go to your point, Ben, they were a great fit for a well-funded startup that had, their balance sheet looked good, and it worked out well all around. So whether you're on the buy side or the sell side of one of those deals, that can be a good opportunity and something worth exploring. So to go to a somewhat different topic, talking about pricing and exit pricing, what are the things that founders should be thinking about in terms of how to position themselves to maximize their exit value?
So going back to that, what I mentioned about KPIs, so definitely profitability is very important. Having a robust pipeline, making sure that, say, 2025 revenue and 2026 revenue, they have a good sort of backlog and pipeline of deals that they can show that supports their projections. Showing good retention metrics, like in terms of keeping the client base, growing them, doing upsell. If there's always churn, but having a good story behind, why there's churn. These are the most important stuff.
I think you just hit them all. No, I'm joking. No, there's other things you do. Like, I think due diligence is really important from the buyer's perspective. If you're looking at a company and they're missing certain elements in their due diligence, I'll give you an example, the cap table, right? You don't have a clean cap table where it's like some ant that was given stock like 10 years ago and it's not on the cap table. That's a problem. There's always problems in your company. And, you want to make sure that you communicate that with the buyer, not right away, but in the process, right? Let's put it that way. You don't want to give them word small first, but in the process, you want to communicate, the negatives and the positives. I had a client that was really interesting in Sweden. It was an IoT space, and he came to me like a month before the deal closed, and he goes, "I've got a problem. My third biggest customer just left, and they have like 20% of the sales. So what do I do? And I said, prepare a PowerPoint with 2/3 good news and 1/3 bad news, right? So you had good news to report, which was great. And then a third was, all the bad news about the customer leaving, and the valuation stayed the same. So you got to communicate the bad news no matter how you do it. That's the key thing. So due diligence is incredibly important. How you communicate with the buyer, it is very important to maintain value.
Just want to Ben's point, once, let's say an LOI is signed until the deal closes, it's all risk for a transaction. So really staying on top of the financial statements, client relationships. If there's bad news, making sure that you communicate that with your advisor or the buyer to avoid change in price.
Yeah, there's a lot in this question. I'm going to add a couple of thoughts myself. On the diligence side, I would underscore that. I do a panel on is top to bottom how to prepare your company for an acquisition. We spend an hour talking about all the things you need to do to get ready. And one of the things that we stress that Ben touched on is on the diligence side, if you haven't been through an acquisition, you don't appreciate how deep the diligence goes and how long it takes and how difficult it can be. And it will go on and on and on and turn over every rock. And what we see as lawyers, because we end up doing a lot of this diligence, is that if a company has prepared in advance and has spent that time up until the LOI, cleaning up its records, getting its contracts in order, if a company has done the right thing in the time up to the LOI, then when the lawyers and the business people are going through the process and going through the records, we'll go, yep, check, and everything checks, then it takes on a momentum. And yeah, this is good, everything works out. Yeah. But if we start finding problems, if it's, there's a problem in the cap table or the resolutions are not in order, well, then we go, okay, so wait, hang on a second. This company doesn't seem very well organized. And that's going to make us start digging a bit deeper. And the deeper you dig, the more problems you find. And it has a self-reinforcing, a negative loop. So that's all to encourage you to clean up that stuff in advance. That's one thing I'll say. The other thing I'll say is when you're thinking about deal pricing, a couple of years out, you know who your most likely buyers are. You know, who they are. Well, not 100%, but you got a pretty good chance. And you probably know what they're most interested in. Is it going to be your talent? Is it going to be your IP? Is it going to be, in every deal, there are different value points, things that bring the deal value. And it's worth thinking early on, long before you get to the sale process, what is it that gives my company value? Especially for a strategic, what are they going to be most interested in? And then maximize for that. Make sure you're building what they're buying. That could be an important part of the sale price.
I'll just add to that. One thing that's really important is to do a department by department analysis of your own company, right? So technology, sales and marketing, admin, financial, how are each one ranked? What's your weakest point, right? And there's always a weak department. And try to bolster that before the sale process. I had a deal, was an Indian buy side, $330 million deal, nice size deal for a boutique. And they're buying a company in Lexington, Kentucky, great company, had their act together, great technology, great team, to your point, Paul. And the tech guy came to do the due diligence, and he came back and he goes, there's one server in the broom closet, and that's their whole tech stack. So they bought the company, they fixed the tech, but they could have fixed that before the sales process. So look at your company department by department and figure out your weakest spot.
So one more observation I'll make in that regard. In my experience, one of the most challenging diligence issues is chain of title on intellectual property. And so I always encourage clients to make sure that's cleaned up, because my practice is representing a lot of startup companies. And in the beginning, you do what you got to do to stay alive, to launch, to make it to the next level. And people don't always focus on all the details. But along the way, you need to clean up those details to make sure that when the buyer comes in, you can show them that for many of the companies that people in this room, IP is the most important asset. Right? And you got to be able to demonstrate that you have rock solid rights to your IP. You don't have contractors that worked for you three years ago that didn't have a work for hire agreement, or you didn't have proper NDAs, or whatever it is. All these things can be a problem, and the longer the time goes on, the more difficult they are to clean up. So, but to move on to a different topic, one thing we'd like to talk about a little bit is your investors and your relationships with your investors, and how they can help or hinder the process of an exit, and how that's something to even be thinking about at the point when you're bringing in your investors. Some of you are thinking about an exit. Some of you are thinking about your next round of financing. So you guys can talk to that a little bit about the process of bringing your investors what the impact of it is.
Yeah, I think it's important to see what kind of value add they bring besides just money, right? Everybody is always like taking the first dollar. I mean, it's a process. It's hard to fundraise. But I had a company, wasn't a client, but they got a billionaire on board, a billionaire with a B from Texas. It was like, wow, this is great. I said, don't do it. Don't take on the billionaire from Texas for no oil and gas in a tech company. And that company unfortunately closed because he had all the money invested and he was giving terrible advice on a software company. So, look at your investors very clearly and make sure there's a fit there. And the other thing to add is they're not always your friends. They have different motivations. Like a typical venture capital firm, and they're sometimes be super helpful, will look at their portfolio, and 2 out of the 10 are going to be the rock stars. 3 out of the 10 are going to kind of muddle along, and then 5 out of 10 they're going to close. So you got to look at the ratios, look at their motivations, and look at the value add they bring to you.
I think to that, when we run a process for, let's say, like sell side process, and we have management presentations, we always tell our clients that this is a sell, obviously, action, like you're trying to sell, but also make it look like the buyer has to sell to you as well, because, you always end up with, a few potential buyers, and understanding that strategic initiative that they're pursuing, and even more importantly, how are they going to treat your team? Because for a software tech company, people are the main assets, and how are they going to, bring on your team and, add them to their existing teams, and how's this integration going to work out? These are make or break, because remember, a lot of the deals currently, they have some aspects of earnouts or, equity piece to it. So understanding all of those questions in advance is gonna help the company know, okay, what kind of value I'm gonna get, 2 years post transaction. Yes, I'm getting some cash now, but I have 15% equity, and I'm not going to be able to control a lot of the decisions. So understanding who you're dealing with and what their plan really is super important.
One other thing I'll say, to go to Ben's point about the cap table, it's not just who the investors are, but I find it's also a matter of quantity. The more investors you have on the cap table, it can become a really complicating factor and a real drain on your attention. So I counsel my clients to the extent possible to avoid too many low dollar investors. To the extent they can hold out a bit and go for larger checks. Fewer investors who are writing larger checks, by all means do that. It simplifies your investor relations situation, but also, frankly, will likely also have an impact on the sophistication of your investor base, because they're more likely to have experience doing other deals, other investments, know what they're getting themselves into, and so you'll spend less time hand-holding with your investors who've never done this before. So that's I have a company now with 175 investors. Many of them wrote $10,000 checks, and it is just, and they've made mistakes on their cap table, and we are just spending hours and hours and hours like dealing with all of these $10,000 investors and trying to clean it all up. So don't do that. I should mention we can do some Q&A if there are questions. Camille has a microphone, so you can just flag her down and she will.
Completely out of the box question for you guys. In the evolution of our company, he came out of another company with the same group of people, and the earlier in our history, we created a product and built a very sophisticated piece of energy tech software that we ended up not launching because we had built it as a marketplace. So the launch was March 30th, 2020. And so we shelved it because it bloated, and we built something else, which we are now doing wonderfully with. But we still have this piece of software. We had an oil major and a bunch of other people as clients. Is that sale? For us, it's a leftover asset that's not really being used, but the right buyer could take it and turn it into a business. And I just don't, I mean, it's a really out of box question, but are those things ever saleable?
So the question is a company that built a piece of software and has pivoted basically and is now operating a different line of business. You still have the software. It's still worth something to somebody. And the question is that in fact saleable? Can something be done with it? Is that the question?
Is that software generating any revenue, or do you have any track record of showing?
It's not generating. It's not doing anything dormant, but it has signed contracts with oil majors, banks. It lives in a separate LLC, and so there's IP, there's the software, there's contract rights, everything else. We kind of shut it all down, and we haven't done anything with it since. But it could be, started back out by somebody who wanted to get involved in it. Same business.
I mean, a buyer usually wants some sort of a proof of concept in terms of, how's this going to generate revenue? But, if you can think of some adjacent sort of, softwares that are already in the market, and your software is, filling the gap in one specific area that the other softwares are not doing, it might be worth sort of talking to them, because instead of them developing that, they can just buy it, right?
Yeah, it's somewhat challenging just to sell code, because guess what? I can build or buy. I can develop my own code as well, right? What you could do is it's a separate LLC, separate financials, is assign one or two team members to it to help develop it, to get to Ellie's point, some revenue traction, some market proof of concept. And then, 6 months from now, it's going to get a much different reception in the M&A market than just go, right? So take a soft approach, not a lot of money into it, but one or two very separate team members for a separate LLC, separate income statement, separate balance sheet, and then see if you can sell it in 6 months.
All right. So yeah, I would say it sounds like that could work as a line of business rather than the bare code. And as dropping it into, as Pat noted, dropping it into a separate entity is sort of a division, and then you can spin it out.
So it's already in. So we've already talked to people who are brokers and other people to use it as an additional, line of business. And so we've already tapped or published on a handful of potential writers. They just haven't gone as systematic.
So I'd like to go on to another question to distinguish a little bit between strategic buyers, financial buyers, how their motives different, and what that means for a founder when they're thinking about the sale of the company and how to approach that process.
You can think of as strategic as more sort of product or sort of client oriented. They already have a line of business, so they might buy your company for a couple of reasons. They might need your product, or they might need your end market. So understanding which one that is very important. Or going into the process. Are they going to be the team? Are they going to, lay off a bunch of the, developers, or, sales and marketing, or, back office sort of operations, accounting? But when you're dealing with a financial buyer, especially if they buy you as a platform, then they're going to need you to have a plan for further sort of growing the business organically and inorganically. So inorganically through acquisition. So maybe having a list of, potential targets that, you can sort of approach after the transaction is very important. But they think of you as, sort of the platform, like a private equity might think of you as a platform, but also they can think of you as an add-on if they already have a larger portfolio company. So they want to sort of add you into that portfolio company.
Yeah, I think, private equity platforms are typically 100 million revenue plus. So it's, people typically want to approach private equity firms to sell. But the key is, if you're below 100 million, it's look at their portfolio companies they've already acquired as platforms and add on to those platforms. Look at strategically, like, I'm going to fit with either 50 different companies they bought. I'm going to fit into these 5 or these 2 as an add-on to their add-on, if you will. So that's a different angle in the platform company. It's a different deal with financial versus strategic.
So we're going to talk for a few minutes about the process involved in an M&A deal and some perspectives on that. So just briefly, there's certain steps that one goes through in virtually every M&A transaction. There is the initial negotiations and conversations that eventually lead to an LOI that gets signed. That goes into the diligence phase along with document drafting, which is followed by the documents get signed. There can be a simultaneous sign and close or a consecutive sign and close. I think a couple of observations worth noting is that the process inevitably takes longer than you expect, and it's more work than you could imagine. Especially diligence is a very onerous process, as we mentioned, and it's something that you need to be ready for. And I always say to my clients, make sure that you don't stop running the company while you're selling the company. Because what can happen is that you get completely focused on the process of the sale and you take your eyes off the financial fundamentals of just running the business. And as the process drags on and you don't hit your numbers, then you've got a problem, because then the buyer is saying, oh, well, you're missing your numbers, and they want to start negotiating down the purchase price, and it can become a painful process. So what I will often recommend is recognize that you're up against a really long, difficult process to get the deal done. and take your team, that certain members of your team, their focus is getting the deal done. Certain members, their focus is keeping the company running. And there will always be some back and forth. But if there's some allocation of responsibility, it can help to make a difficult situation a little bit easier. You guys want to?
Well, it's very important to have a clean set of financials before getting into a potential process. That's why we were working with companies that have never raised capital or they just grew organically through years. We usually recommend a quality of earning so that a sort of professional accounting firm looks into their books, looks into their trial balance, everything, and just puts together a set of financials that then when we go to market with those, there's a high level of certainty and accuracy of those. Because as a founder, the last thing you want is that you go through a process, you get an LOI with like $100 million price, then you start the diligence process, and then the buyer finds a lot of things that they don't like, and then they basically retrade and lower the price. So doing that, making sure you have good financials is gonna just, lower the probability of something like that.
I think it's important also to keep track of your 10 most likely acquirers and your 10 direct competitors. So I had a client one time, he was like in the silicon chip business, and he was obsessive about, the top 10 acquirers. Who are they? What have they acquired? What price did they acquire at? What was their strategy behind the acquisition? How would he fit? How would he fit into that strategic acquirers portfolio? He was obsessed with the top 10 acquirers. And then he also tracked his top 10 competitors. And what he realized was the two had been sold already the last month. And as soon as your competitors start getting sold, your value is going down because you've got less buyers to sell to. The supply and demand in M&A. So he very cleverly hired a banker, me, to sell the company, and we did very well. But he hired a banker, even though my job to sell the company and to get the top 10 acquirers. But he was obsessive about it. It's really good to keep track, like trying to keep your head above just the operating the company every day and look at the corporate finance field. It's going to be helpful with your investors because 90% of companies exit with M&A. And if you are on top of that, you're going to help with your investment and it's going to help with your sale.
So guys, any sort of final key takeaways, advice for founders that are getting ready for an exit?
I think, be obsessed with your product and your clients. If, you see a downsell with one of your clients, be very careful, like what's going on there, because that might, end up becoming a churned client, which obviously is going to, affect, the financials and then also, your KPIs. But, just keeping, close track of your financials on a monthly basis and weekly basis, that will help you sort of know and predict any bad things that might happen.
Yeah, I think it's important just to look at as many options as possible, to look at not only your top 10 strategics that are going to acquire you, but also corporate venture capital is one other area where they often have like corporate venture capital units of strategics that will actually invest in your company on a minority basis. Look at venture capital, obviously. Look at private equity portfolio companies to sell to those. So there's family funds. Look at a lot of different options and then go for a few of those to see what options are at the table at the end. That's the key. If you can decide between financing your company the next round or selling to Microsoft, they're going to have different valuations on each, you'll be in a great spot.
So I think a final thought that I would say is to return to the theme that I opened with, which is, to my mind, the key is always, and we've said it from different perspectives, the key is readiness. To not let the opportunity for a sale surprise you, but to be, amidst everything else that one needs to do in running one's company, focus on the details. Focus, as Ben said, understand what the competitive landscape looks like. As I was saying, make sure your house is in order. Make sure that everything is ready, because I would say 50% of the time when one of my clients is sold, they didn't see it coming. A term sheet came out of the blue, and all of a sudden they were in a process. And it was a good deal. I mean, it was a deal they wanted to take. But that's the thing. You don't necessarily control when the moment comes. The moment will come at you. So you need, to some extent, you need to be at least at a low level degree of readiness at any time if you really want to take advantage of that big opportunity when it comes at you. So those are...
You as kind of company founders and owners, you probably get a lot of emails from private equities or, any sort of financial strategic buyers. This is a research that was done, I think, at Yale University, and they looked at a large sample group of companies that got offers and unsolicited offers, and then they hired bankers. They ended up basically with 40% in average and higher value. So understand that if you're getting a call or an email from a buyer, that is not your only option. Always, as Ben mentioned, you have a lot of options. Look at all the different buyers that are in the market, different strategics and, financial buyers. There is, if some private equity is showing interest in you, you can be sure that there's actually going to be 10 more similar to that. That's going to want to look at your company. So.
Great, thank you. Are there any final questions?
One question was earnouts. Is it bad or a good thing?
It depends on how it works out, right? That's it's earnouts are tricky. It depends on the percentage of value of total consideration. If it's like 50% earnout, that's not good. If it's icing on the cake, if it's like 25%, 20%, that's great. The mistake a lot of people make is they have very, very frothy forecasts, right? Because you want to keep your sales team motivated, you want to keep your team motivated. So let's do, the reach goals, right? Don't use those for your earnout, right? You should have a conservative number that you can reach. And then for year 1, year 2, year 3, and then also other goals within that, they're more reach goals. So if you knock it out of the park, you get rewarded for it. And having conservative number in the earnout at just a base level is good for the buyer too, because you don't want to buy a whole team of the whole company and then a year later they're not hitting their earnout. They're all going to leave, right? So it's good to have realistic goals and have reach goals within the earnout structure.
And, as I mentioned earlier, when you sell your company, you lose control, a lot of control in, decision making. So when it comes to, the budget for sales and marketing, like, how many more people, how many more developers you can hire, right? Because earnout is usually pegged to some growth in revenue or EBITDA. And in order for you to do that after the transaction is closed, you have to be able to have some control. So being very careful and putting all those details, we just did that like in March. We spent a lot of time with the buyer putting all the details in terms of, what kind of flexibility and what kind of resources the company owners will have, because they had 15 million in earnout. It was a large transaction, but you have to, as a company owner, be very careful about it's all details that you have to be, understand them very well.
Yeah, I will say I have very strong feelings about earnouts, and I will tell you, one party in a transaction that will do very well with an earnout is the lawyers. The earnout, I cannot tell you how many deals we've done with earnouts where getting an earnout right and negotiating something that both sides will agree to, it's long and difficult because you got to get the targets right. What are the milestones, and then there are really significant control provisions as well, because you've got to have enough control to have the resources, the staff, whatever, to be able to meet those targets. But the buyer is not likely going to want to give you that level of control over the company. They're buying the company. They don't want you to control the company. And so it gets negotiated back and forth, budget, personnel, though. I mean, it goes on and on. Often we see as the lawyers that a deal will start out with an earnout, and after a whole lot of time negotiating, they'll give up on it, and they'll just go back to, they'll come up with a fixed price that everyone is equally unhappy with, because the earnout is so difficult. So I'm not, for my client's sake, I'm not a fan of earnouts.
This one quick comment. I think, I just did an earnout relatively recently, but, there's a presence earnout, which means if you're the founder of the company and you're alive after a year, and you're still with the target company that bought you, your presence is enough to trigger the earnout. There's no other financial metrics. There's no product metrics. If you're alive and kicking and at the company, then you get an earnout. That's the easiest and simplest by far.
That's why I go with that, right?
It's a retention bonus, right? Essential. It's a good way to look at it.
All right, I think we're going to wrap it up there. We have contact information. If you scan the QR code, you get contact info, and you can also leave us your information. That way we will be distributing the video of this, maybe of interest, maybe to your colleagues. And also there's some materials that we're going to have available, a couple of white papers, a slide deck that I think you all might find useful. So if you leave us your contact info, you'll receive those materials, as well as getting on our mailing list for other panels and webinars we do on these and similar topics. I should also mention that on Thursday, same place, same time, we are doing a panel on preparing for a VC finance transaction. Basically, it's the VC equivalent of saying, what does the VC market look like under the current market climate? So that we have a couple of VCs that will be joining us for that event. So make sure you register. It's being well subscribed. So anyway, thank you all very much. We have food still. Eat hearty, there's plenty. Thanks very much, and big round of applause for our panel.